Hello, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, your host. It is Sunday, January 28th, about 6:15 p.m. So the markets, the E-minis, US E-minis have opened, and of course, Europe is already open, and Asia, and some of these other markets. But wanted to look at the S&P 500, which is what we have here right now. This was our last week here in the S&P 500, which was a tremendous bullish move last week. You can see right here, I mean, just there's nothing to say about it other than just very bullish. And what you're seeing here, what's interesting is the slope of this climb is actually increasing, which is very bullish while it lasts. And we actually could, I've changed this to a log scale, and we actually could see this, work its way up on this log scale, north of this 3100 area. So a lot of bullish action in the market right now. Very, very, of course, there's, it's big returns and potentially, large losses. So you have to be really careful. If you can get in and out fairly quickly, within a day or two, then maybe it's okay to ride this wave. Sometimes what is good is to put up a, let's see, like a 5-day moving average. So what I'll do is I'll go to a daily chart. Let me go to like a 6-month daily chart. And then just real quick, sorry, I got a little sniffle going here. Let me just put on edit studies, simple moving average. Can't remember if it's under MA, yeah, MA or SMA. Yeah, moving average, simple. Here we go. And what I want to do is just edit that and make that a 5-day. Sometimes a 5-day moving average is very good when you get a lot of momentum like this. You can see it's been tracking the 5-day moving average. But normally when you get a break of that moving average, a substantial break, maybe if you had something like this and then a follow-through day, another day lower, then it's probably time to get out. So you can see this 5-day moving average is more or less been holding, the whole time. If you wanted to be a little bit more conservative, you could look at a 10-day moving average. The more days you put out, the further you put it out, the more risk you have to take to stay in. That's kind of how that works. So you can see here the 10-day moving average holds for all this variability and has been holding. But that's one way to maybe get in and have a non-arbitrary way of staying in only when you want it to. See, how do I do that? Cancel. I'm not sure how. I'll just leave it on there for now, I guess. But anyway, that's it's just very, very bullish. We're in the very late stages now. Very late stages could last another 2-3 weeks, I suppose. So very late stages doesn't mean get out tomorrow. But I'm going to show you some numbers here from EWI that are pretty amazing. In fact, let's just go look at those now. Well, here, just this first, it says sentiment is eye-popping in a wide array of markets, aligning with wave structures that indicate an approaching change of trend. This week, the daily sentiment index, tradefutures.com, hit 91% bulls in gold, 90% palladium, 94% platinum, 90% in the euro, 90% in the CRB, 96% in crude oil, and only 8% bulls in the US dollar. When added to the 96% bulls in the S&P 500, and the record 97% in the NASDAQ, the financial markets are approaching a culmination point that will lead to decline in stocks, precious metals, forex, commodities, and oil, and a rally in the U.S. dollar. We will discuss this in upcoming blah, blah, blah. Okay, so these are huge numbers. I mean, trend change happens all the time at numbers lower than these. So it's just very, very, very stretched. But it can remain stretched for some time. So, there's I think when we finally do sell off, people are going to be amazed how fast the sell-off goes, possibly. But right now, people are amazed at how fast the market is going up. And you heard something the other day that over last weekend, on Monday, something like $32 billion flowed into the U.S. equity market, which is a pretty high number. I don't have a chart on what that looks like over time, but that's a very, very high number. Meanwhile, let's look at the 13-week Treasury. You can see it's still around log scale. Let's go back to it. Right? So I was on log scale on the S&P 500 because let me just show you. The arithmetic scale, we're so far out on that now. See how far above we are on that scale? So I made it log scale, and I'm assuming that we could move to this next area up here on this channel, which is around 3,100, 3,200. So that's still 250 points away. So that's quite a bit of move left potentially still. So anyway, let's go back to the 13-week Treasury. Look at that. So we'll get back on the arithmetic scale here. So we're above this line still substantially, and you can see this line is actually, the slope is increasing on it as well. So we can take a line and kind of draw it here. And so now I would expect this line to steepen just because the yields are going up, and I think we've talked about that enough here that everybody knows kind of what's happening. In fact, if we go to the 10-year, we've talked a lot about how this low is important. Let's back up a little bit. Let's look at some more time here. So this is the previous low right here back in 2012. We came up, which looked like this was going to be the run up, and this was going to be the pullback and then take off. But then we came down and made a lower low. So now this low is an important low. We ran up, pulled back in a corrective looking manner to a higher high, and now we're taking off. And that is not good news for the bond market in all likelihood. So just to kind of give you an idea, just a 0.5% move in yields, so let's say or let's just say 1% move from, so right now we're at 2.662. So a 1% move would be, 3.662. You're talking about a loss in the $2 to $3 trillion range in the bond market, just with a 1% move in yields. And you can see they've already moved, almost that. So we're, maybe 3/4 of that. So we've already lost a couple trillion. And when we move up into this area, north of 3.5, that's going to be another couple of trillion. So you got to remember, a lot of retired people are, they're tied to fixed income, which is another way of saying bonds. So that is not going to be good. And if people have really, really piled into these markets, you could get a move very, very quickly. And the next time they open their statement, they could have lost 20% of their money or something like that. So in something that they are perceiving as relatively, safe. So you just got to be careful in this bond market. If you happen to know somebody, older, you might want to say something to them. All right, let's look at these foreign markets. Germany looks really strong. It's got a steep chart as well, a steep curve on its move up. And generally speaking, these tend to stay intact. I know this sounds silly, but they stay intact until they're broken, like so. So just, if you're in it, stay with it. If you're not, you're going to have to make a decision as to whether or not you want to chase it. personally, I'm not chasing anything. But, you know, a lot of people do. Like, a lot of people chase. You can see Japan really took off last week. I mean, that is a big up move in Japan, especially after all this kind of chopping, you know, finally broke out, pulled back just a little bit, and then has been rolling up ever since. That's a huge move right there. So Japan, their money printing seems to be working for their market. Whoops, keep hitting the wrong button. The United Kingdom, I think even the United Kingdom is going up. So you can say a breakout of the channel here, but now potentially in resistance, although that's a pretty strong looking candle. Usually when you get a candle like this at resistance, that means that resistance is not likely to hold. So we'll just have to watch these markets. You know, these are pretty steep slopes on these moves up. So what you could get is you know, a little bit more of a run up and then some consolidation, and then maybe another leg up. But I think that depends on probably the bond markets and things like that. So at some point, going back to the bond market, yields are going to become important to the equity market. A lot of the low yields have fueled the rise in equities, and so you know, you're going to have some people go, golly, that's, you know, with yields moving up, that's going to hit equities, and so they'll try to get out in front of that. Let's go real quick. I want to go back over here and show you something else. This is something you ought to try to go watch on YouTube. This guy right here, his name is Paul Tudor Jones, and he's this is called Legendary Traders or something like that, and it's about Paul Tudor Jones. It's pretty interesting. I think you'd enjoy it. The guy had a 19% return for like 30 years every year. I mean, it's pretty crazy. And one of the things they attribute,
Paul Tudor Jones is one of the most famous and
there's a video that was done years ago called Trader, and I have a copy of it from the web. But he's gone out and removed all the copies that he can potentially remove, because it reveals something about his technique. Now, I don't know. I've watched it several times, and I don't know what it's revealing. Although they found some, you know, in the 80s, they talk about they have a market correlation where they picked a place in time where the market looked the same as it did at another place in time, and they made a lot of money on that. But go out and watch this little YouTube video. It's called Legendary Traders or something, Paul Tudor Jones. It's actually pretty interesting. It's let's see how long it is. It's about 13 minutes, not too long. And I just think you'd find it very interesting. This guy is one of the most successful traders in the last 30 years, and almost nobody knows who he is, which is always interesting. I find that to be interesting. Same thing with Jim Rogers. Almost nobody knows who Jim Rogers is, and he's not a trader. He's more of an investor, but he's wildly successful, and almost nobody knows who he is. And anyway, I just thought that was a little anecdotal thing I thought I'd bring up. Let's look at some of these other markets. Let's look at gold. Gold, we've talked about this. We had all these different scenarios. It looks like it definitely is going to come into this area before it, you know, turns back down. So, you know, if you're long gold, stay long gold, maybe until, you know, between 1400 and 1450 area, somewhere in there. I think then you got to start really watching it. Make sure you don't get too greedy. Same thing with silver, except silver, you know, maybe if you're long silver, stay long silver until you get to around 1890 or so, and then look for silver to pull back from there. All right, the Euro US dollar. The Euro US dollar continues to be strong. It's blown right through our little support, our resistance area, and you know, it could very well be that this is kind of a wave one up, and we're going to have some sort of pullback, but then, you know, the euro is going to take off. which means the dollar would shorten. But the question is, how much is the euro going to pull back, and how much is the dollar going to rally before these trends that we're currently in resume? Because right now, a lot of people think the dollar is just done, and I don't think so. Because first of all, it's moved a long way already. We can look at the dollar. Let's look at the dollar real quick. Do I have it on here? I can't remember if I have it. Well, I could type it in. Thought I had it on here. It's $DXY. So you can see the dollar has been going down and really started to accelerate last couple of weeks, last 3 or 4 weeks here. So to me, this looks like a wave, a 1, 2, 3. So we should get like a 4 and then a little 5 down. We might already be in 4 if we zoom in a little bit here. This might already be in a 4. Look at see here, got a rally up. So this could be like A, B, C up to here, and then boom, back down. That could be 4. So let's go back to a weekly. So, the dollar may be about done going down here. And if that's the case, then the euro is about done going up. So we want to look for positions in the opposite direction in those two markets. What else do I want to look at over here? I think I want to look at the other. There's a good forex setup, I think, here. And I'm at the higher time frame right now, the weekly. This is on a weekly chart, and you got the U.S. dollar CAD, so Canadian dollar, U.S. dollar on top versus the Canadian dollar, and you can see we pulled back into this support area, this decision point area, on a weekly time frame. So this looks very much like an A, B, C, right? So we're in support. We're in support right here, and then resistance is up here. Now, if we go to a daily time frame, and let's zoom in on this a little bit, what you're seeing is you're seeing an important low, okay, a rally off that low, and then a pullback. And it's hard to see here, but there's actually a DP setup right here on MT Predictor. So if I hit trade setup and click right here, it's given us a DP move to here. Now, one of the reasons only given to here, I think, a good trade would be to up here, but you could have, for example, this could come up to here and then make a new low or lower than this low, not this low, and then you could take another run at it. That's why this is only taking this trade to here. But if you're inclined to, this is always a good trade set when you have this important low, a move off the low, and then a pullback. And this pullback looks pretty deep too, which is usually a good sign that this is in fact a wave 2. In fact, if we go to like let's do a 10. Let's lengthen this a little bit, and if we click on here for Elliott wave intermediate right here, you're probably going to see this come up as a wave 2. Yeah, see, it's a wave 2 or B. So they're looking at this as a wave 1. This is a 2. Now that doesn't mean it has to be that way, but if it is, you could very well trade into this area, this resistance area up here. And let's just set that trade up for a second. You'll see that it's probably pretty substantial. So if we enter here, sell here, but trade to here, see that's a 4-to-1 trade. It says risk exceeded based on the numbers I have, but here, let me just get this down. This is too high up. But it's a 4-to-1 trade potentially. So I think that's a very good looking trade setup. In fact, every time I see one like that, I'm going to take it, because it's not a high probability trade, but you can lose money on this trade, 6 times in a row or so, and still make money maybe not 6 times in a row, but 4 or 5 times in a row and still make money on this over the long term. So these are good investment trade setups. Okay, so that's on the US dollar CAD. Again, let me go back to the daily and look at it on the daily, and you can see. Let me remove that. Clear all. So you can see here. Now, Steve teaches that you don't take long setups against a red trend, except in a Holy Grail. So a Holy Grail is a 3-wave move. So if you were to kind of do a wave setup and select 3, where this is the bottom of wave 1. Here's the top of. I guess that's the top. One of those is the top. Can't tell which one. Let's just pick this one. This is the top of wave 1, and then this is the bottom of wave 2. So it's talking about a typical wave 3 move up into this area. So now if we do a trade setup on that, if we do a risk reward, let's say we get in on a breach of this candle, but get out below that candle, and we trade right up to here. See, that's a 10-to-1 trade setup. So technically you could trade this exact setup 6 times in a row and lose, and on the 7th one you would still make money. That's how good a trade this is. So in this particular case, look at this. You can take $180 risk. So if I got in at 1.23920 pip, 1.23920, and set my stop at 1.22811 and traded to the target of 1.35685, with $180 risk, I could potentially make $1,909. I mean, that's an excellent. Let me scoot this down so you can see it. That is an excellent trade. So out of the Forex markets, this is the one that I see that is the best right now, and I'll be looking at probably taking this tonight or tomorrow, and we'll just see. We'll see how it goes. Take a look at it next week and see how it goes. But again, the rationale behind the setup is, if you look at the weekly, you got kind of this larger. Let me do this. Instead of a weekly, I'll do a 5 or a 10 day, which is 2 weeks. Okay, so you got this move down that looks a lot like an ABC. Okay, then what you've got is you've got a low, an important low that so I took a DP off this low and we moved right down into support, rallied up, pulled back, but so far to a higher low. In other words, we haven't breached this low. So we want to be looking long here. So we waited for a trade setup on the next lower time frame, which is a daily. So when I look at the daily, boom, there's my trade setup. You can see it there. It's a DP trade setup. Now again, this is against a red trend. So this is a little bit, for what Steve teaches, is a little bit risky. So this could come up a little bit and then come down and make a slightly lower low, and then you'll get another DP, or you'll get a TS3 or something like that there. So it could be that this is a little bit too early. But like I said, you can take this several times in a row, and it's a 10-to-1 trade. So that's always a good setup. All right. Let's go back to. You see the dollar. Well, let's see what the euro. I guess the dollar's not trading yet or something. So the euro's down a little bit right now. Euro opened down. If you can see that or not. Euro opened down right here. And then, like I said, this could be the start of that wave 4. So you could have, 1, 2, or ABC, and then boom, 5 up to here or something before the euro's done. So keep an eye on that. The reason I like trading the euro, U.S. dollar is just because it's so much in the news. So it tends to follow very good Elliott wave patterns. We didn't look at oil. Let's look at oil real quick. Oil, I think, is right smack in the middle of resistance, and could start turning the other way. This looks very corrective, although very choppy corrective. You can kind of see, the overlapping nature of this. And I think we've got kind of a DP zone off of this previous high here. So I think I think oil's days are numbered here. I don't think oil's going to go much higher than where it is right now before we roll over, and it'll probably come down into this 39.80 area, which should be nice because gas has gotten back up there. It's a little bit more expensive again, and it's a challenge for the economy when gas is high. So, all right, everybody, I guess that's it this week. Be careful in this market. I know I've been saying that a long time. It's making a real idiot out of me, but it is very, very dangerous. I mean, it's very, there's just a lot of momentum to the upside, and momentum is fine as long as you can handle the momentum and get out. Let's see. I was going to pull up. Thought one of the things I'd do real quick is just pull up the Dow 30, and go back. I don't know if I can go back. I think I can look at all, and then look at daily. That's going to be kind of hard to do, but I just wanted to look at this 1929 area and just show you, see how steep it was, and then it kind of flattened out, and then was steep. I mean, this is every bit as steep. This probably is very similar to the market that we're in right now, but I want to show you how fast it fell. So these are daily bars. So here's the high right here, 380. What is that? 384.1875. Okay. Next day, gap down, ran down, but it came up, and then next day gapped way down, but ran up, sold off again. And then just look how fast we start falling. So in a matter of now, this is quite a bit of movement here. So in a matter of let's say from September 1st to October 1st, this lost. Let's just see from high from here down to here. That is 50%. So in 1 month, think about that. In the span of time that you get your statement, market lost 50%. So be very, very careful. These markets are at extraordinary levels, and you can just see the run up into the 1929 high was very, very steep and great. You can make a lot of money, but you got to be able to get out. You can't hold through this move. I think we've shared here before that this move from high to low was about 89%. I mean, if you had all your savings in there, you'd just be wiped out. So, of course, it made it back, but it didn't make it back until what's this? Around here in 1955. So you lost all your money in 1930. It wasn't until 1955 to get it back. So that's a long time to wait to get your money back. And certainly with inflation and everything, you're not getting all of it back. So just be very, very careful. In a big bear market, the name of the game is preserve capital, because what you want to do is you want to be a buyer down here. You want to just load the truck up and buy all the stocks you can buy down here, and then let it make money. You don't want to be a buyer up here at the top. And if you look at the market we have, it's much more likely that we're at a top. Here, let's do this. Let's look at 20-year and let's look at daily. So here's the March 9 low right here. So, I mean, just look at the market historically. When we're at a peak, and of course, who knows if this is the peak or this is the peak or this is the peak, right? But the point is, when you're at a peak, that's, you're closer to the peak than you are the bottom, right? Same thing here. Here was a kind of a double top, but one was slightly higher. So we had here looked like the peak, and it ran down, probably shook out a lot of people, ran back up, and everybody said, "Oh, you're an idiot for selling," and then this happened, right? So, this is not the beginning of something. This is closer to the end of something. Now, does that mean that it could go to 29,000 or 31,000? Sure, I mean, it could absolutely do that. But you got to be smart about this. You can't buy at these super duper extremes. Another way to look at it, I'll tell you a great way. Let me put on another study real quick, and then we'll end today's session. I want to put on something called a Bollinger Band. And a Bollinger Band just looks at, it's a standard deviation kind of tool that looks at, price action from a standard deviation standpoint. So this is what I've got up on the chart right now is a 20-day Bollinger Band. So, and it's 2 standard deviations. So what it's showing is that at any one point on here, so right now, this price, with this price right here, I forgot what 2 standard deviations is, but it's like 93%. 93% of all price action falls between this number, which is 26,739 and 24,480. Now, if I increase this to 3 standard deviations, so if I edit studies, I come over here, and this is on a 20-day average, by the way, but let's increase this to 3 standard deviations, hit OK. Now everything inside the Bollinger Band represents 3 standard deviations, which is 96% of all possible price action or whatever. So anytime you can see that anytime it touches a Bollinger Band, it doesn't stay there long. And you see right here we touched and we kind of went sideways. My guess is we're probably going to get up here and we're going to touch this thing, probably get close to 27,000, maybe even go over 27,000 a little bit. And then it's going to pull back, and it'll either pull back and that'll be it, or it'll pull back and then rally back up again, or it could go sideways for a while and then rally up again. But you can see how this Bollinger Band tends to, it tends to be a good, anytime you touch one side of it, it's time to take a little risk off the table. Does that mean it goes down? Not necessarily, but you just have to have some sort of method for gauging risk. You can't just be blind to risk, I think is the point. All right, everybody, that is it for this week. Thanks for coming in. It's going to get real exciting. I mean, you could see another blow-off week next week. We're another 100-point week or whatever. I don't know what we had this week. I didn't look at it. I probably should have. Let's see what the range was this week. Sorry, I'm doing a lot of clicking here, but let's just see what the range was this week. The range was 64 points. So from low to high was almost 65 points. That's a big range. I mean, the range previous week was only 41.5 points. Previous week was 51.5. And then this week the week of January 1st was pretty high. The last week of last year was only 18.5, 18.5, 28, 40. So, you should see volatility going up, even though the market's going up, because the actual volatility, and that's interesting. Last week, even though the volatility in the market is expanding, the volatility in the VIX is actually contracting, which is interesting. So there's all kinds of weird stuff going on in this market. Just be careful and don't get too extended. Don't add money you can't afford to lose and things like that. Okay? All right, everybody. We'll see you next week. Take care. Bye-bye.